Have you ever noticed that sometimes the best performing companies have stocks that seem completely disconnected from their actual business performance? That's exactly what's happening with Meta Platforms right now. While investors continue to obsess over massive AI spending, data center construction, and capital expenditures that seem almost unimaginable, they may be missing what could become one of the biggest wealth building opportunities in the market over the next several years. Today, we're going to discuss why I believe Meta is setting up for its next major leg higher, why Wall Street is struggling to properly value what the company is building, and why the path to $1,000 plus stock price may be much clearer than many investors realize. Hey there, my name is Anthony. Welcome to Growing Your Wealth. Let's start with the numbers because the first quarter of 2026 was nothing short of remarkable. Meta reported revenue of approximately $56.3 billion, representing 33% year-over-year growth. Think about that for a second. This is not some tiny startup growing off of a small base. This is one of the largest companies in the entire world, producing over $56 billion of quarterly revenue and still growing at more than 30% annually. Operating income climbed to nearly $23 billion, while operating margins remained incredible at 41%. Even after all the spending, all the hiring, all the infrastructure investments, and all the AI development costs, Meta continues to generate profitability levels that most businesses could only dream about. But if the quarter was so strong, why didn't investors celebrate? Why wasn't the stock immediately rewarded with a massive re-rating higher? The answer, to me, is simple. Investors became fixated on one number and one number only. It's capital expenditures, CapEx. Meta increased its full year 2026 CapEx guidance to between $125 billion and $145 billion, which represented a significant increase from previous expectations. The market saw that number and immediately began to ask questions. Why does Meta need to spend this much money? I mean, how long will it take to generate a return? Is management simply throwing money at AI because everyone else is doing it? These concerns caused investors to focus on the cost rather than the opportunity.
Steve Weiss joins us via Zoom. As nobody on this desk today owns this name, but plenty in our orbit do. Weiss, where are you looking? We're over here.
There you are, Scott.
So now you can join us. I'm not sure what planet you were coming back in off of, but we're right here. So you bought more Meta this morning. So are you undeterred by what you got in those results and this 9% decline in this market today?
I don't strive to own the worst performing stock, on any day in any market, but that's what I've got. But as I look at the quarter's phenomenal. And if they didn't announce the addition of CapEx, I think you'd see it trading up 10% instead of down 10%, because every point was a great point. The growth, we haven't seen this kind of consistent growth, mid-20s, in a long time. And it wasn't completely off the table, as we know from prior quarters, that they would raise their CapEx. But there you go. There they did, and they announced a bond offering also today for $60 billion.
See, so let me suggest real quick why, look, right. As I mentioned, some of the others have raised their CapEx too, but yeah. I don't feel like, and I'm throwing this out for you to react to, I don't feel like the street necessarily trusts Meta spending as it relates to what the others are doing. At times, this company has spent so much money in disparate places. Now, I'm not suggesting that AI is a disparate place because everybody is spending money in that particular area. But a few quarters ago, or 2 or 3 quarters ago, their spend was greeted poorly. And here we are yet again with the spend being greeted poorly because I'm not sure that the street trusts that the money is being spent the right way or in the right amount. Is that fair?
The irony is that investors are making the exact same mistake they have made repeatedly throughout market history. When Amazon spent heavily, building fulfillment centers, many investors questioned the strategy. When Netflix spent aggressively on content creation, many investors questioned the strategy. When Alphabet spent, billions building cloud infrastructure, investors questioned the strategy. Yet in each case, the companies that invested aggressively before the returns became obvious, those companies ended up creating enormous shareholder value. The market loves certainty, but wealth is often created during periods when uncertainty prevents the majority of investors from recognizing what is actually happening. Meta's management team clearly understands something that much of Wall Street still doesn't fully appreciate. Artificial intelligence is not simply another product category. AI is becoming the foundational layer that enhances every single business Meta operates. This is not a separate business unit. This is not a side project. AI is being embedded into Facebook, Instagram, WhatsApp, Facebook Messenger, advertising systems, content recommendations, customer service tools, business messaging, and eventually personal digital assistants used by billions of people. When you view AI through, that lens, the spending begins to make much more sense. Consider Meta's advertising business. Advertising already generates the overwhelmingly majority of the company's revenue. Now imagine, just clear your mind and think about this. Imagine what happens when AI continues improving ad targeting, content recommendations, user engagement, and conversion rates. If advertisers receive better returns on their advertising dollars, they spend more. If users spend more time on Meta platforms, there are more opportunities to monetize engagement. If AI helps, businesses automate customer interactions through WhatsApp and Messenger, entirely new revenue streams emerge. The company is essentially investing in a technology that can improve every major revenue-generating engine at the same time, simultaneously. We're doing this together, boys. One of the most overlooked aspects of Meta's AI investments is the scale advantage it creates. Anyone can develop an AI model. What very few companies can do is deploy that model across applications used by billions of people. Meta's family of apps reaches more than 3 billion users worldwide. Every improvement in AI can be immediately distributed across one of the largest digital ecosystems on the planet. That's an advantage that startups simply cannot replicate. It's also an advantage that many investors underestimate because, I believe they're focusing on the cost rather than the distribution network that already exists. Another reason why I believe Meta is preparing for its next major move higher is that the company has already proven its ability to monetize AI. During the quarter, management discussed how AI is improving advertising performance and user engagement. Advertising pricing increased while ad impressions also grew, demonstrating that the platform is becoming more valuable to advertisers rather than less valuable. This is critical because it provides evidence that AI investments are already producing measurable business benefits. We are not discussing a theoretical future anymore. We are beginning to see real-world results. I like that. Now, let's discuss why the stock appears stuck. Despite these impressive fundamentals, the market hates delayed gratification. They're impatient. It is what it is. Investors see billions of dollars flowing out the door today and have difficulty assigning, value to cash flows that may arrive several years from now. The increased capital expenditure guidance dominates headlines because it's easy to quantify. Future AI-driven revenue opportunities are much harder to model. As a result, investors focus on what they can see immediately while discounting what may eventually become more valuable. Well, far more valuable. This creates a fascinating setup. Meta's business continues growing at rates that many smaller technology companies would envy. Revenue is growing, profits are growing, user engagement remains strong. AI adoption is continuing to expand, yet valuation concerns, they remain tied almost entirely to spending levels. In my opinion, that disconnect is temporary. Eventually, the market will stop asking how much Meta is spending and start asking how much money these investments are generating. When that transition occurs, I believe the stock could move substantially higher. Okay, so think about how quickly investor sentiment can change. Okay, today, capital expenditures they're viewed as a burden. Tomorrow, they may be viewed as a competitive moat. Once investors see AI driving, higher advertising revenue, increased monetization of WhatsApp, stronger business messaging adoption, improved user engagement, and entirely new product categories, the narrative changes completely. Instead of asking whether the spending is justified, investors begin to ask whether Meta's competitive advantages are becoming impossible to replicate.
Back to what Jensen Huang of NVIDIA told me ahead of the Super Bowl. To Josh's point, and I think his direct language was, nobody uses AI like Meta or better than Meta.
Yeah, for sure. They're a great user of Meta. I think they are excellent at their acquisition strategy. Rather than spending money on trying to grow organically, go make acquisitions again. What'd you buy Instagram for? $1 billion? Right. WhatsApp was what, $20 billion? They're really good at making acquisitions and building out that social platform.
It's a company that's like trying to make fetch happen. So they've got this, this Muse Spark model. They want to see corporations use it. They want to see it get traction amongst consumers.
Another factor supporting the bullish case is Meta's financial strength. Even while spending at unprecedented levels, the company remains enormously, profitable. They're a cash cow. Management isn't funding these investments through desperation. They are funding them from a position of strength. Meta continues generating billions of dollars in operating income and free cash flow while maintaining a fortress-like balance sheet. They're stacked to the ceiling. They even pay out a dividend. What are we talking about? This means the company has the flexibility to pursue long-term opportunities without jeopardizing its financial stability. There is also a psychological component that investors should consider. Most market participants tend to extrapolate current concerns indefinitely into the future. Right now, the concern is AI spending, but eventually AI spending will mature. Infrastructure buildouts will slow and investors will begin evaluating the earnings power of the completed system. When that happens, Meta may be generating significantly more revenue while spending proportionately less on new infrastructure. The result could be substantial margin expansion combined with higher revenue growth. That combination has historically been a recipe for explosive stock performance. Let's talk specifically about the possibility of a $1,000 plus share price. Many investors hear that number and immediately dismiss it as unrealistic. But when you consider Meta's earnings power, its dominant position in digital advertising, its growing AI ecosystem, its massive user base, and its potential to create entirely new revenue streams, the valuation becomes easier to understand. If AI investments continue driving business performance improvements and the market begins assigning a premium multiple to those future cash flows, a 4-digit stock price becomes far less controversial than it appears today. The key catalyst is not simply revenue growth. The catalyst is investor recognition that the AI spending is producing attractive returns on invested capital. Of course, there are risks. The company could spend more than expected. AI monetization could take longer than anticipated. Competition, well, it still remains fierce, and regulatory scrutiny is always present. And there is no guarantee that every AI initiative succeeds. Investors should acknowledge those risks because no investment is without uncertainty. However, when I weigh the risks against the opportunity, I continue to believe the bullish case is compelling. Meta is not spending aggressively because its business is weak. Meta is spending aggressively because management believes they have a chance to strengthen an already dominant position. That's an important distinction. Companies that invest heavily from a position of weakness often struggle. Companies that invest from a position of strength, daddy, they frequently emerge even stronger. And this is my belief, but I believe this is where Meta's at. As I look ahead over the next several years, I believe investors will eventually view 2026 as a pivotal year in Meta's evolution. This may be remembered as the period when the company laid the infrastructure foundation for the next decade of growth. While many investors remain focused on today's expenses, Long-term shareholders may ultimately benefit from management's willingness to think years ahead instead of quarters ahead. And I remember the same investors when they dropped this stock below 100 back in 2022. They were panicking, and just look where it's at now. So if you're wondering why Meta could be preparing for its next major leg higher, the answer comes down to a simple concept. The market currently sees spending, management sees investments. Investors currently are looking at costs, Meta sees infrastructure. The market currently sees uncertainty. Meta, they see opportunity. And when the return on those investments become obvious, I believe the conversation surrounding this stock could look dramatically different than it does today. So, as you look at your portfolio, let me leave with you some wise words from the book of Proverbs 24:27. Prepare your work outside. Get everything ready for yourself in the field. And after that, build your house. Meta is laying the foundation first by investing heavily in AI infrastructure before expecting the full financial payoff. The companies that create the most wealth are often the ones willing to make unpopular investments before the payoff becomes obvious. Meta's first quarter of 2026 demonstrated that the core business remains incredibly strong. The AI investments are massive, but so is the opportunity. If management executes as successfully as they have in the past, the current concerns surrounding capital expenditures may be viewed as one of the greatest buying opportunities of this AI era. And if that happens, a $1,000 plus Meta stock price may not be a matter of if, but when. All right, that's it. Let me know your thoughts in the comments below. Do you think the market is being too pessimistic about the future of Meta? Let me know. And if you're curious about my thoughts on Celsius, well, click right here. Okay. I think Red Bull and Monster have some real competition coming, and I don't think they're ready. So that's it. As always, happy investing, and may God truly bless each and every one of you.